morning and welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts, for Monday, January 4th, first trading day of the new year. And I'll tell you what, the new year is starting off right. And again, as we talk about the Santa Claus Rally, the last 5 days of December, the first 2 days of January, markets are starting off on the upside, of course. This is just after the market did set a new high last week, but just barely getting there. And of course, now as we start to look over the next couple of days, this begins the first week of January. First 5 days of January typically denote how January plays out, the month, and then January, of course, for the year. But the issue here in the short term is that the money flow indicator that we track is turning positive here, and that does suggest that in the short term, we could see a continuation of this momentum-driven rally in the short term. Look, there is a tremendous amount of exuberance in the market currently. Margin debt is spiking up rapidly at this point as retail investors are now piling into leverage to take on additional trading action in their portfolios. That increase in margin, of course, is leading to the fuel that's providing this advance. Secondly, though, the market did consolidate for almost 3 weeks here, really not going much of anywhere. And the breakout of that consolidation here with the money flow signal turning positive now does set the market up for a bit more rally here over the course of the next couple of weeks. But now here's the real issue. Is the market now setting investors up for the classic old rug pull here? As we saw both in 2018 as well as in 2020, we saw the market rally in January of 2018 with a 20% decline in February. Same thing in January and February of 2020, which led to that 35% decline in March. Both of those just a correction, not a bear market, because long-term trends weren't broken. This is kind of where we set up this idea because markets currently very extended from their long-term moving averages. In fact, some of the greatest deviations we've seen in the history of the stock market. Currently, the market's trading in the top 5 most deviated extensions from the 200-day moving average that we've seen over the last 30 years. So again, these type of deviations don't last long, and lots of exuberance and leverage within the markets also typically sets up the markets for a reversal. So again, you kind of have all of the underpinnings set up here for a quick retracement in markets of some unexpected event. What could that be, of course? Well, the runoff in Georgia over the next couple of days. That could be a problem. The other problem that we have, of course, is the dollar. The dollar here has been really kind of basing here, but within a downtrend, but that downtrend now slowing here, starting to firm out here a bit. The decline in the dollar has been a strong tailwind for the equity rally over the course of the last year. A reversal in the dollar, of course, which is a mirror opposite of the stock market, extremely oversold, extremely deviated from long-term moving averages. A rally in the dollar could really change the dynamic of the undertone of the overall equity market as well. So again, something to be watching here is a reversal in the dollar. So there's a lot of things here over the next couple of months that could really kind of derail the bullish excitement of the markets, and again, really set the markets up for a 10 to 20% correction, certainly within the realm of possibility and normality for markets on any given year. So pay attention to the risk. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you tomorrow.